see the title of my talk there. There's a lot of forces at play for the markets right now, but I really think that there's only one outcome to worry about. And so that's what I'm going to talk about. When I say there's a lot of forces at play, I mean that it's complicated. Gold is always complicated. I would say that it is perhaps especially complicated these days. In general, gold gains when people flee to safety, but gold is also hurt when people flee to the other thing that they do for safety, which is the US dollar. So those are opposing forces. Gold thrives on uncertainty, but it also thrives with inflation. Again, opposing forces. Gold is thought to move against the stock market a lot of the time, but it hasn't for the last decade. So that's an interesting one as well. Well, not for the last decade, but it's certainly in recent time that hasn't been the case. One takeaway from all of that, I think, that has helped me, especially in the last little while, to remember is that gold's first reaction to economic events often isn't its inherent reaction. Instead, it is stemming from a bigger market. So, I mean, the gold market is absolutely tiny relative to, the currency markets, the stock market, the bond market. And so when there's a big event, those markets matter more, and gold gets moves almost by proxy as opposed to on its own. In time, or a little bit later, then we get the movement for gold's sort of inherent response. But the takeaway is that all of these points notwithstanding, if time is on your side, the details don't matter because precious metals are going up from here. Now, clearly the fundamental force driving that are negative real rates. Negative real rates are always the most important bull force for gold. And we have been guaranteed, all but guaranteed, that the negative real rate environment that we are in is here to stay. I'm going to return to this point several times in the next few minutes here. You can see this 10-year inflation-adjusted treasury yield chart. This is obviously a proxy for real rates, which are interest rates corrected for inflation. When real rates are negative, it doesn't make sense to hold dollar-based instruments because you're paying to hold them instead of being paid. And so gold steps into the gap. When that's the case, when real rates are negative, gold makes a lot more sense for safe money. I think here, I get a lot of questions about timeline, about how long this market will run. Is it too late to enter? Remember that it took 7 years for the Federal Reserve to raise interest rates again after the Great Financial Crisis. Now, clearly, COVID-19 is different from the Great Financial Crisis, but I think that time frame is still relevant. I think it's important to remember that this isn't going to change anytime soon. We are going to be in a zero interest rate environment for a long time, and there's going to be inflation. Now, that brings me to the US dollar and to inflation. I would say that we had clearly a really fantastic move in the gold price in July and August. A lot of that was because of rising inflation expectations. There's all kinds of reasons for that. Stimulus being a big part of it, straight up money printing, growth expectations, but everybody started to expect significant inflation going forward. Now, when inflation rises, but interest rates don't, of course, your real rate environment only goes more negative. So that's the inflation side of the coin. Of course, inflation inherently means a weaker US dollar, which is also significant because US dollar strength has hindered gold over the last little while, over the last few years. But I think there's reason to believe that that structure is changing, that the US dollar bull days are shifting. Adding to some of the other reasons for that, China is in a long game to reduce its reliance on the US dollar. That will continue to progress in ebbs and flows, but that really matters long-term for the strength of the US dollar. There's all the money printing that has its impact, and in a very related vein, the immense debt loads. And then the trade wars. When the trade wars were really terrible, the US dollar turned down a lot. So I really think that US dollar will be less of a hindrance to gold going forward, and that matters. So negative real rates are the force. But the other key thing that's going on right now is that gold is almost unique as a safe haven right now. When things go, a really important factor is that these big pools of low risk capital that are in the market always used to own bonds. That's what they owned. They got 5 or 6% annualized return from bond yields. That's what they did. That game stopped with the great financial crisis and the monetary machinations that followed. And so low risk capital had to shift to the stock market. That has been a huge reason that the stock market has gone on the bull run that it has since the great financial crisis, which is fine. Will that bull run continue? It could well do so. I am not going to predict that, but the risks in the stock market are very real. There's all kinds of metrics you can look at for this. The one that I'm showing here is bankruptcies and how we are on track to outpace some of the worst years of late. And that's not a huge surprise given everything that has transpired in 2020. The takeaway from all of these points is if low risk money has to play the stock market and it's been doing okay with it, that's fine. But it is low risk money, so it has to hedge the real risks in the stock market. What does it do to hedge them? Well, it can't buy bonds. That's where this conversation started. Bonds don't give you yield, and they often come from extremely leveraged companies and or governments. And so gold is one of the only opportunities there. Then I think, going back to that first slide, things are complicated right now. There's a lot of events and conflicting pressures in the gold space. One takeaway from all of that for me is that I look back and I think about, okay, well, the US election, that's really important. COVID, obviously very significant right now. The trade war has quieted down, but is very much still present. What does it all mean for gold? Well, I really think that gold will do well no matter what happens in any of those scenarios. That's a pretty bullish statement to make, but the US election, if Biden gets in or if Trump gets in, we are going to get more stimulus. We are going to get perhaps inflation, and we are going to remain in a zero interest rate environment. So we're going to have more negative real interest rates, no matter who's president. With COVID, if cases rise, then there's uncertainty, there's a flight to safety, that benefits gold. If there's a drop in cases, well, then we probably get growth-based inflation in a zero interest rate environment. That benefits gold. The trade war, if it escalates, sort of like a rise in COVID cases, we'll get a flight to safety. The Chinese will probably push more towards that gold-backed structure for its international trade. That benefits gold. If the trade war de-escalates, well, then we probably have faster global growth, inflation. Guess what? That benefits gold. So I think that perspective helps calm me somewhat when the news flow seems so crazy and it's hard to understand what each individual event might mean for gold. The two things I do is not worry about it on a daily basis and try and take a step back and think about where are these things going? Oh, they all end up doing well for gold. Okay, well, if things are so fantastic for gold, then why are we in this moment of weakness right now? It certainly started with the death of Justice Ginsburg. And the reason that mattered primarily is because the stimulus package, the large stimulus package that had essentially achieved bipartisan support, evaporated overnight. And the markets had already priced that in. When they had to take that away, then inflation expectations dipped and the market had a fit. Both of those things happened at the same time. And so in dipping inflation expectations, that directly hurts gold. The market having a fit hurts gold in general because gold got sold alongside everything else. At the same time, there was a flight to the US dollar just as a safe haven move in reaction to that lack of stimulus and fears that that would impact growth. And also because the euro turned down at that moment because case counts in Europe were particularly bad. That also worked against gold. And then there's probably a seasonality aspect as well in terms of portfolio rethinking and profit taking that happens regularly in September. Another aspect that is quite interesting is the speculative positioning that's been going on in China. This is even more pertinent to the silver market than the gold market, although it has happened in both spaces. There is a lot of private and public companies and individuals who used money that became available as a result of COVID, easy money, as we like to call it. In the same vein that Robinhood trading gained such momentum here in North America, futures trading on precious metals gained a lot of momentum in China. And futures trading on anything is super fun when your bets are right. You make a lot of money really quickly. And then when things change, it's not so much fun anymore, and all the money that you made evaporates quickly. And so this, I believe, added significantly to the ramp in prices and then the downturn and the volatility, especially on the downturn, because there was a lot of inexperienced futures betting going on the Chinese side, and they had to exit those positions. I think this force will be less going forward because of the lessons learned with as the gold price turned down recently. But it's important to note that that was going on. Okay, so what else has been hindering performance on the junior explorer side of our market? Well, there's been a landslide of free trading dates. It's great that so many companies were able to raise money sort of May through August. It means that lots of teams are out doing exploration, and more exploration means more potential for discovery. And this is what feeds excitement in our market. And that's all great. The unfortunate corollary is that there's a lot of shares coming free to trade for stocks that had seen share price gains in the interim during that 4-month hold. And so especially it depends on a lot of factors: how many shares were issued, how much the gains were, what the news flow looks like. It's a complicated setup, but in general, a free trade date for a stock that has gained is going to push back on those gains. So that's a factor that's quite at play in the junior side of the space right now. Slow assay labs are also hurting. They're a problem. There's nothing we can do about it right now, but it's taking sort of twice as long to get results, and investors don't love that. And I'm sure I know that management doesn't as well. And there's certainly some profit taking. We did well for quite a few months there, from call it April through August, and you can't begrudge some selling from mining investors who've been waiting a long time for it. I think I used this exact slide a month ago, but it's important. This bull market is running. It's happening. I believe it's going to happen for quite a few years from here. And so the question you want to ask is, what are you going to do about it? Not what's your neighbor doing about it, or what's the CEO of company X doing about it. What are you going to do about it? You have to decide that the market is going and understand the forces enough to make that decision, to watch those forces enough to know when it changes. I think that's a few years out, but those are the background pieces of the puzzle. And then you have to know yourself. You have to decide how much time you want to commit and how much risk you can tolerate in your portfolio. Once you know that, then you can set your expectations appropriately. What's great about a gold bull market is, whether you're a trader or an investor, whether you speculate on exploration and discovery or bet on leverage to a rise in gold price, it all works. It just works with different timelines, different risks, and different needs in terms of how connected you are to your portfolio. This is just one example down here. The GDX has a fantastic gain this year. That is really low risk exposure. You got better than 50% just owning GDX over the last year. Evergold is an example here of a stock that was up 6 times that. It was up 300%. But of course, exploration is usually a roller coaster, even when it's successful. So that's why you have to decide what game you want to play. Which of those you want to play? Do you want to sit somewhere in the middle? Make that decision, and then you're more likely to succeed. If you want to speculate on discoveries, I obviously do that day in, day out. I love it. There's a few comments that I want to make to those of you in similar shoes to mine. First of all, don't let the seeming flood of discoveries make you think that it's easy. The fact that all these companies were able to raise money is great. It means there's more exploration happening. That means there's more discoveries happening. That's fantastic. But remember that the odds of success on any one target remain low. That's the nature of our game. That's why success is so rewarded, because it is unusual. There's ways to address that risk. So I think you want to demand from a company more than one good target and or project. That's just an odds game, right? If you have more kicks at the can, it's more likely that one of those kicks will make it into the goal. And you also definitely want to demand strong technical competence from the team doing the exploration and rationale for why they're doing what they're doing and why they're the people to be doing it. It's not easy. And so you need expertise and you need rationale and you need multiple opportunities. Then there's the fact that geology is risk enough in the exploration game. So you want to demand that the other risks that are involved in exploration are limited or managed to the best degree that the team can do. So is permitting managed? Is exploration seasonality a big limiter, or are there other projects that can keep them going through the winter? How is that going to work for the stock? Are there access or logistics challenges to simply carry out a drilling program? Does the team have a marketing plan? No one's going to buy a stock if they haven't heard about it. That stuff all really matters. They're just considerations if you like to play the risky end of the spectrum. If you still like explorers, I'd say some comments here. You got to trade. Buy and hold is rarely the best plan for exploration, even when it is successful. You want to pay attention to where the price is moving and why it's moving and what's coming, and just make sure that you stay on top of that. I would say buy in tranches if you're entering a stock, especially if it's already rising, and then pay attention to pre-result speculation, free trade dates, seasonal forces, discovery price spikes, and what might happen following. It's important to trade. You can't just hold on to these stocks. If you like explorers, certainly watch out for new deals. There's a lot of new deals debuting these days, companies that are shifting focus, companies that are IPOing or RTOing, private groups that have been advancing projects for a while. There's a lot of really interesting stuff coming to the fore that's brand new. So get a line on, find someone who can give you some information on those and watch for them. If you can participate in financings, warrants certainly increase your opportunity for upside. So see if that works for you. And stay engaged with the story. This is what I say, you need to decide how much time you want to commit. If you want to invest in explorers, you got to stay engaged with the story. Don't get too attached, but make sure you stay engaged and you understand what's coming. There are other options. If you don't want to do all of those things that I just told you have to do, which are a lot of things, remember that you can build a buy and hold portfolio that will perform through this market and will require very little attention and carry very little risk. You can buy Barrick Gold for large leverage to the price of gold. That's what Warren Buffett did. You can buy scale and growth, mid-tiers or majors that have particularly good growth profiles. You can buy royalty companies because guess what? They outperformed miners in the bull market, in the bear market, and in the bull market. So that's a pretty good track record and not one that you should bet against. You can buy optionality plays. Huge assets are specifically hated in weak markets because they are expensive to advance. And then when the market gets strong, there comes a point when suddenly the few large assets that retained momentum, that kept progressing, becomes super sought after because big companies need big assets to stay big. So that's the optionality play, is focusing on the few big assets that are good and make sense and will get taken out because they become so sought after once this market gets established. You can look for takeover targets, and you can certainly bet on silver because it outperforms gold in a bull market almost every time. There's also a bit of a middle ground. Some stocks combine exploration upside with fundamental value, whether that's because of a mine plan, whether it's because of a portfolio of projects with a lot of technical expertise. These I would call the sort of some trading middle ground. These are all comments that to try and help you understand that you need to try and decide what game you want to play, and then you have a much better chance of winning that game. How much trading do you want to do? How much holding? How much following of your portfolio? These questions really matter. Choose your own adventure. We're set up for a very exciting few years in gold and silver. Corrections like we're going through right now are part of the process. So consider how much focus and risk you want to commit. Build a portfolio that works for you. Trade, and don't get too attached if that portfolio involves explorers. And then stick to your plan and find a few good sources of information.